Welcome back to the Driven to Succeed Real Estate Podcast. I'm your host, Brandon Olson. Today I have a special guest in Brad Martin from the Right Thing team at Bridge Realty.
Thank you.
Brad, welcome to the show. So Brad, this is your 20th year in the
It is my
business,
20th year and as a real estate agent. Yep.
Awesome.
It's been a fun run.
Well, so 20 years ago, how did you get, what decided, I'm going to go sell real estate?
Yeah. I mean, what really made me want to get into the business was when I purchased my first house in 1996 for $62,000,
Yeah.
I might add.
Right.
Times have changed. And, that was after I graduated from the University of Minnesota, and I worked in the corporate world for about 11 years. And in that first 8 years of owning my house, I was there for a little over 8 years. I sold it. I sold it for $169,000. And that was at that time in my life changing.
Right.
And it really made me realize the value of owning a house. It's just so important. And it enabled me to move up. And, I had my three kids were born in that house. And then when we needed more space and wanted to have our dream home, it enabled me to do that. And that was one of the things that made me want to get into this business, because it allows you to generate wealth. And I just think it's so important. If I had been renting that 8 years, it would have been a completely different situation. So yeah, I got into the business in 2005, and I've been doing it ever since. And obviously the last 20 years we've seen everything, I think, that you could see.
Right.
Different probably from multiple generations. But experienced the market the way it was in 2007, 2008, and everything was foreclosures at the time. And so been through, up markets, down markets, buyers markets, sellers markets.
Right.
So it's been a very interesting ride, to say the least.
Right. So, and you get into the business 2005, couple short years later, then there's a housing crash.
Yeah.
Right. And 20 to 30% lost values and homes. One of it's kind of looking at a lot of those differences and talking over the last number of years with different real estate agents. It's like, if you had been in the business 10 years versus being in it 2 years,
mm-hmm.
a lot of those people in 10 years are like, I'm out. Like, I'm not doing it anymore.
Right.
I'm burnt out on this,
Yep.
blah, 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 blah. But being a couple years in, and here's what happens.
Right.
And it does change people's, outlook on real estate.
Right. Yeah. I'm glad I stuck with it, because I remember at the time, there were a lot of people that just got out of the business because it was scary.
Right.
And so it was a very interesting period of time, because at that time, pretty much every house that I was part of selling was a foreclosure. And,
right.
And if you had purchased a house at that time, that was a really good opportunity if you were able to do it. But,
right.
People weren't really selling, if you didn't have to move, you probably didn't.
Right.
For obvious reasons. But then, and then of course, in the years to follow, the market has been great, seen great appreciation. And
yeah.
And
well, let's before we dive into a couple other questions I have for you, let's talk about that though, because when I bought my first home in 2006. Got married, bought my first home, and then 2 years later, $70,000 less in value, right?
Yep.
And I had friends that were in a similar position because we were all fresh out of college and buying homes. And I had some friends that I'm just letting it go, right?
Right.
And they went and rented. And then I had the other friends that kept them.
Mm-hmm.
10 years later, I'm up $100,000.
Right.
Yeah.
And
so this is why I wanted to bring in how important that is. Because a lot of people right now, think, hey, we're in this bubble. It's gonna, this housing bubble.
mm-hmm.
And we'll get in a little bit later about why that may or not be, right? But it's even so, at that time, 30% lost values. 5 years later, it was back to even. So if you just kept making your payment on your house,
mm-hmm.
right? Now, if you lost your job and you went to foreclosure, that's a different story. But
Right.
there was people just walking away from homes because they were lost value on paper. It's like
Right.
the stock market goes down and you sell all your stock
Yeah.
at the
You
down
sell low.
point.
Yeah. Yeah.
It's a paper
And
loss.
it was really, and I know we'll touch a little bit on this a little later, but that was a different time.
Hmm.
The conditions were completely different.
Right.
The lending standards were really loose.
Nil.
Yeah,
Right.
if any.
All right.
People were buying homes, frankly, that they couldn't afford. Even if the market hadn't crashed, some people probably overextended on their what they could
Right.
afford on a monthly basis. So, when foreclosures started, when things really got tough, I mean, yeah, a lot of people walked away from their home. It was really sad. It was a really,
Right.
really sad period of time for a lot of people. But as we're on the subject of first time home buyers, I think it's important to note that make sure you have a budget and you buy a home that you can afford,
Correct.
because then regardless of what happens, you stay in your home, and inevitably it always works out because historically the market is, the trend is going to be
Right.
up.
Well, and let's just hit on that real quickly. The lending standards at that time were really very minimal, right? And they were doing a lot of arms. And it gave the industry, both real estate and mortgage, a bad name. Mortgage specifically,
Right.
because right, and the predatory lending, all of this stuff. And it was like, okay, we're gonna put you on an arm, maybe even a zero interest arm for 2 years,
Mm-hmm.
and then it's going to adjust, right? Well, the payment is $1,800, and then by the time it adjusts to a 5% interest rate, 6% interest rate, and it stacked up, you
Yeah.
went from an $1,800 payment on a ridiculous home, $500,000, $400,000 home,
Yeah.
and all of a sudden, and this was a lot of money in 2005,
Right.
right? And also, oh, I can afford this 18. Well, now it's 3,200. Now it's 3,800. Now it's going foreclosure,
Yeah.
right?
Yeah.
So that's where that bubble really, really took off, right?
Right.
So now going back to what you were just talking about, the lending standards are so much different, right?
Yeah.
So, as a lender on my side, whether it's a client that's on the third home or the first home, we really, it's a lot easier when they're on the third home talking to them through this. But on the first home,
Right.
it's like, just because I can make it on paper that you can afford $450,000. Is that realistic?
Does it mean that you should?
Correct.
Yeah.
Right. Are you prepared for this $3,200 payment and be cash poor?
Right. And then there are a lot of cases where it does make sense, but
Mm-hmm.
it doesn't always make sense.
Yeah. The times it makes sense is like, okay, the wife's not on the significant other's not on there, or, this is the plan we have, I have a couple roommates that are moving in,
Mhm.
and I'm on a fellowship right now, and next year my income is going to go up significantly. There's
Right.
multiple different reasons why we can push those limits.
Mm-hmm.
But having those conversations and having that guidance so that they don't get themselves into trouble, right? Because it's been for the last number of years, it's been an affordability issue.
Right. Yeah, and it's it's probably more important now than ever because home prices are higher.
Mm-hmm.
Interest rates are, higher historically compared to, the last
Yeah.
15 years.
Right.
So they're,
Right.
So it's definitely an important conversation to have. That's something that you and I do every day,
Right.
with our clients, just to have kind of a reality check and just make sure, hey, are you comfortable with this potential payment?
Right. Absolutely. Brad, what are some of the questions that you get from a first time home buyer? You've done this a number of years.
Mm-hmm.
You probably get a lot of the same questions over.
Right. I get a lot of different questions from first time home buyers. Oftentimes it's, what types of programs are there for first time home buyers, whether it's grants or, any kind of incentives, can you get a better interest rate? Everything from where do I start?
Right.
And the obvious answer to me is the best place to start is obviously to talk to a lender.
Mm-hmm.
Because that's going to shed a lot of light on what can I afford? What can I qualify for? What would my payments look like in different price point scenarios? and it's really not that hard to do. I mean, you know, you have to provide information, as you well know.
Right.
Um, but it really doesn't cost you anything. It takes a little bit of time, and I think you walk away with a lot of important information. You know, what price range should I be shopping in order to stay in the budget that I want? So first advice would be talk to a lender. Ideally, I'm happy to go and show you a house if you haven't talked to a lender,
Right.
but that would be a piece of advice that we would get to, which happens a lot because again, it's first time homebuyer. You haven't done it before.
Correct.
I don't expect you to know.
Right.
Um, but yeah, just a lot of questions about what type of programs. I know there's down payment assistance programs available, a whole variety of different programs that are available through the state, through certain cities, things like that. And that's where I'm going to defer to Brandon.
Yeah.
Really. I mean,
Yeah.
because that's what Brandon does.
Correct.
That's what a lender is
Yep.
going to do for you.
And I will always, so I build a whole tech company around doing a pre-qual first, right? Now, some lenders don't. Go to the app, go to my website, do an application, send me
Right.
the docs, right? That's fine, right? But the reason why I like to always 100% have a call before you do that, before I invite to do that, is so I can understand what you're looking for, right?
Mhm.
And we can start to formulate, number one, once I get the application in,
Yeah.
I'm not playing investigator to try to figure out what you're doing, right?
Right.
Oh, is it a second home? Is it,
Mhm.
what is it, right? So, you know, as a first time home buyer, you know, doing a pre-qual, I call it the mortgage framework. And, you know, what do you do for work? What do you know, what are your
Right.
bills? You know, when I talk about bills, what's on credit? You know, do you have a family? Do you have a significant other? Do you have kids? Do you have all these different things that, you
Yeah.
know, so I can understand what we're looking for, right?
Yeah.
Because I mean, reality is everybody goes online to find a
Right.
house, right? They'll find an online calculator and like this house is $469,000 and my payment's $3,200.
Mhm.
Sweet. You know what? I can make that work.
Right.
The reality is that payment calculator didn't have the correct taxes, didn't have the correct homeowner's insurance quote,
Right.
didn't have mortgage insurance. Oh, it had 20% down.
Mhm.
You're only doing 5. That payment's $4,000.
Right.
Right. Oh, that doesn't work. Right. Many different reasons why that could potentially be the issue. And that's why I also built an accurate calculator for everybody out there. So like if you're using my calculator, you're going to get real numbers.
Right.
Anyway, it's very important. Then, you know, we can talk to things like if you are going to use down payment assistance, what are those? Because a lot of people, hey, I'm a first time home buyer. You just graduated college and you have this great job and you're actually way over the income limit.
Right.
And you got a bunch of money in the bank. So unfortunately, that money is allotted for the people that do.
Yeah,
need
and
it,
not
right?
everybody's necessarily going to qualify, and sometimes it's not even the best
Correct.
option.
No,
And
no.
that's also a valuable thing to learn. But I can relate. I just think it's so important to actually have a converse. First of all, they know they're talking to a human being,
Right.
and you can get to know them, understand their particular situation, and you know, have an idea of kind of what the goal is here.
Right.
And yes, it's nice to have all the technology and all the things that make all of our lives easier, but that personal touch, I'm old school. I like to talk to people.
Right.
I like to get on the phone and have a conversation.
Right.
I feel better about it.
Oh,
So
for sure. I mean, I've always, and I'm just going to take a little side note here. It's the lack of conversations at the beginning and throughout the process where with me, you know, I'm not out showing you the home. A lot of times we're emailing or texting. Maybe there's a phone call, maybe I send you a video message, but we don't get that one-on-one communication
Right.
anymore.
Mm-hmm.
And there's different, some people, that's what they want, right?
Right.
You know, maybe usually it's their third, fourth home. Like I
Yeah.
know how this works,
Yeah.
whatever. But even on my side, I still don't feel like that stickiness
Right.
to like, I want to get to know my clients,
Yep.
you know, and you know, part of that is because I want to make sure that you're feeling taken care of. Right.
Right.
And that's where you lose that in all this technology.
Yep.
And like we are here, if in my opinion, in this business, if you're in this business, you are here to take care of your client.
Correct.
Now I know a bunch of companies that hire people that just do, I mean, it's just a machine, right?
Mm-hmm.
And there's a lack of, and guess what happens? Things get messed up and now they're upset, right?
Yeah.
And it's just because that stuff wasn't done
Yeah,
at the beginning.
because those conversations weren't had.
Right. And you
In
didn't
a lot of
know
cases.
what that person
Yeah.
really was looking for.
Right.
And, buying a home, going back to what you talked about earlier, like that, how it changed your life. Yes, owning a home is a wealth building thing, right?
Yeah.
Yes, there was a decrease in values in 2008. And we'll jump in that a little bit right now. Like some people
Mhm.
think there's going to be a bubble right now, right? And they're overpriced. And, I want to point out in 2008, there was 23,000 homes in the Minnesota or the metro area on the market at that time.
Right.
Crash happens, 10,000 foreclosures come on. Now there's 33,000 homes.
Right.
And the last I checked, I think we're right around 9,000 homes on the market.
Yeah. Well, I mean, somewhere in that range.
Yeah, it goes up and down.
Yeah,
But under 10,000.
Yeah, under 10,000 for sure. You maybe even closer to six or seven.
Right?
Yeah.
So it's let's just say there was a mini crash and we added 10,000 more homes on it. What
Right.
would happen in that case is rates are going to plummet,
Mm-hmm.
right? And the people on the sidelines are going
Yeah.
to come in. So I can't see there's that crash really being
Right.
taking
And
place.
I've heard talk about that in the media too. And, obviously our crystal balls are broken.
Right.
We don't know what's going to happen, but I can tell you, at least from my own personal experience, comparing now to, back in that 08, 07, 08 period of time,
Mhm.
even after, the conditions are so different right now. I don't see the conditions right now setting up in a way where we're going to see a big crash. There's always going to be little lulls and things
Correct.
like that. And again, who knows? But the market is still strong. In fact, right now, I think for first-time home buyers, while the sticker shock is there because
Mhm.
home prices are high, the trend is probably going to continue. I mean, year over year, last year to this year, I think home values were up about 3%. And I don't see any reason why they won't continue to go up. And if interest rates actually do come down, that's just going to increase demand and then home prices are going to go up. So my point in this is that right now, homes have actually been on the market for, on average, longer than they have
Right.
been in the past. I think the average right now is about 35 to 40 days on the market.
Right.
That gives an opportunity. There are homes that we can get offers in, and we might be able to get that house for you for less.
Right.
Not always, depending on how the house is priced, but the opportunity is there because if there, as you mentioned, I feel like there's a lot of buyers on the sideline hoping for interest rates to come down.
Right.
But the thing to keep in mind is when that happens, if and when that happens, those folks are going to come off the sidelines, buy more homes. Supply is going to go down and home prices will go up. So, it's a personal decision. Do I buy now and hopefully get a better price on the house, or pay more later and get a lower rate?
Right.
And
the one thing you can change is your rate.
Right.
So there's a couple of different tactics right now. There's different. Everybody's got different. When I have a client, I go through first of all, when we're going to lock their loan, right? Can't lock. There are programs where you can lock and shop. You don't want to do that now because there's more pressure for rates to go down.
Right.
And then if you lock and shop, you're actually locking at a higher rate in the first place. That was great in 2022 and 2023 when rates went up to 8%.
Correct.
I'm going to lock at 6 because I don't know where they're going to go. And they did go to 8, right?
Yeah.
It's ridiculous. But some of the tactics that, specifically in the wintertime in Minnesota, there's not as many active buyers.
Right.
And if there's a house for sale, and that's been sitting on the market there is an opportunity, like you said. There's also the opportunity, what I like right now, I mean, realistically, we're in the low sixes, right?
Right.
And in some cases in fives, right? And then there's other cases where like, hey, if we do have seller paid closing costs, but we can also cover closing costs on our end, well, maybe we use that to buy discount points.
Right.
Maybe we can get you to a 5.5% interest rate. Now your payment is X,
Yep.
right? Now you don't have to really refinance unless rates go to 4,
Right.
right?
Yeah, and to your point, there are ways to, in a lot of cases, to negotiate those types of things into your purchase.
Correct.
So
I will say it's better to do it this time of year than it will be in March, April, May.
yeah, yeah,
That's where a lot of, I mean, that's just, I mean, time and time again. Oh, we're looking in the spring. We're looking in the spring. Well,
Mhm.
what's stopping you from doing it now? Because we may be able to do something sooner than later.
right, right. And again, even if you are not able to,
Right.
buy down your interest rate, if rates come down, there's always the opportunity, if they come down enough, to refinance where you've locked in your house at a certain price. You know, the old saying, and I know this is overused, but I still love it. It's, date the rate and marry the house,
Right.
and
I mean,
but it's true.
It's true. I have probably 1 out of every 5 will do no discount points because they do watch the market and they do see where we're going. Now, again, back to your crystal ball. Nobody does know. We might not have lower rates next year at all.
Right.
Right. The trend and what's setting up, the new Fed chair is probably going to be announced in a couple weeks.
Mm-hmm.
That Fed chair is going to be very, very,
let's lower the rate friendly.
correct.
Yeah.
Yeah. Put it that way. Because that's what the administration wants.
Right.
Right. And they want affordability. They're coming up with different things. They're coming up with a 50-year mortgage right now. So
Right. Yeah.
people, and here's my take on
That's
that.
a whole nother conversation.
I'm gonna go on a little rant on that a little
Yeah,
bit, right? So here's the thing. How many people do you know actually keep their mortgage for 30 years?
Yeah, not many.
Not many. A lot of times, if they do, it's because they moved out of that home into a new home and they're renting that one out and they had a low rate on it.
Right.
That's the ones that go. The vast majority of people are going to sell that home within 10 years, or like a first-time home buyer is 8 to 9 years.
Right.
So you're not carrying that 50-year mortgage. Now you're probably going to have less equity at that 8 to 9 years, but it might be more affordable. And the reality is they're giving that option to help make affordability.
Mm-hmm.
The very few numbers that, I mean, there's been 40-year mortgages for a while.
Right.
I've never done a 40-year mortgage.
Yeah.
Right.
Really.
I've never
really
even
uncommon.
quoted one.
Right.
And so there's that 50 that's going to make it a little bit cheaper,
Mm-hmm.
but ultimately in the end, it's like probably going to lower $200-300 on a home.
Right.
And you're like, okay, well, if we look at the actual amortization,
Mm-hmm.
you're likely to be like, well, I can't afford this at 30 years. Right.
Yeah.
It's another tool. It's another thing, but it's getting
is.
a lot of attention. Like, oh, they're going to put people in really bad spots. I think the very few numbers that we're going to see in that,
Right.
like we don't even have it yet. So
yeah. And that's where, and I wouldn't claim to be an expert on it either. My personal opinion on that is, to save maybe a couple $100 a month, it's going to be a lot harder to build equity in that period of time, because you're going to be, your interest over the life of that loan, however long you have it, is going to be way higher.
Mm-hmm.
But who knows? There might be situations where it may be beneficial.
Right. It's going to be unique. It's just
right.
It's gaining more traction. I think in my opinion, it's more the affordability.
Right.
And like how can we make this affordability work?
Yeah.
In some cases it will work.
Yeah.
Right. In other cases it may not.
Mm-hmm.
Right. So again, I still think that it's going to be such a few number of homes that we're going to see. That
I don't
that do it. It's not going to be that big of a deal.
I don't see that taking off huge.
No,
who knows?
But again, 50 years. Like I saw when they first announced it. Right, I saw that the other day, and like of course was on X, and I was reading all the comments, and so I was just keeping my mouth shut. But it's going to be another possible way. We're not going to see this huge influx of homes that are going 30 years. We're
right.
50 years. We're just
right.
not.
And I think as you even as a loan officer, when you have those conversations, I think a lot of people are going to arrive at the same conclusion anyway, which is it probably makes more sense just to stick to a 30.
Right. Right.
Most likely.
Mm-hmm.
But it's a good conversation to have.
Yeah. No, it is. It is what it is. I know there's some times where I've had, where it's going to make sense for a few people, and that's when that's a different story. But
Right.
again, it's very unlikely that you're ever going to see that go 50 years.
Right.
It just isn't going to
Yeah.
happen.
Yeah.
Most likely what's going to happen is you're going to see a 50-year, okay, we're going to do a 50-year, but here's what's going to happen the next 4 or 5 years, and we're going to refinance out of that 50 into a 30 or 20 or whatever it's
Yeah.
going to be, right? Those are the cases that you're going to see it. Right. That's where I
mean, it's
think
kind of
it's gonna
funny to
happen.
think about a 50-year mortgage. See, where am I going to be in 2075?
Right. Exactly. Well,
But
right. So, that going back to what the affordability and what, they really are focused on. There's talk about title companies, right? And title insurance.
right.
The cost of title insurance and why what that cost really is.
Right.
So there's some changes that we're going to see in the future. How big, we don't know, right?
Yeah.
But I mean, they're looking at credit reports, right? Because the tri-merge credit report, when I first started doing this over 10 years ago, I think our cost was like $30, $32.
Yeah.
$110. It's
Right.
three times that now, right? So they talked about, okay, let's get away from a tri-merge. Let's go to a single bureau. Let's go to a advantage score model. Advantage score model typically has higher scores for people.
Right.
What does a higher score do for a client when you have, let's say you pull the tri-merge with the FICO specific scoring model now, and it's a 646. But you do the advantage score and it's a 676 or a 681.
Right.
Well, that 640 to 681 from a mortgage cost standpoint, from interest rate, from mortgage insurance, cost of the interest rate is astronomical difference.
Yeah.
And what's the reason behind that 640 versus 680? Oh, they had, over 32% usage on a credit card, and they had a late payment 2 years ago. That's why they're in this. Well, the advantage score kicked that late payment out. Is not worried about that 32%, but we're a 680, and that payment is now magically $200 a month cheaper, right? So there are those things, and then there's times where I've had clients where, hey, if we just pay this down, like, do you need to buy us? Like, what's your time frame, right? Well, my lease is up in February. Okay, so it's December 5th today, 4th, whatever it is, December 4th. So it's the end of February, right? When's your due date on your credit card? Oh, it's on the 17th. Can you pay it down to this on the 17th? Yes.
Yeah.
Boom.
Yeah.
Okay, now we can get that score.
It's a relatively easy fix.
And now that, maybe they had to pay $1,000 to get that paid down, right?
Yep.
That $1,000 is going to save them tenfold on their mortgage, right?
Right.
So
hundreds of dollars.
right.
Right.
It makes a giant difference. So that's what I love about my job, is being able to, specifically having the experience that I have now and 10 years into doing this, is being able to have those discussions. So full circle, coming back to what you said, one of the first steps in the process for a first time home buyer.
Yeah. I mean, I mean, whether you, talk to a real estate agent and you go look at a house, or you just proactively, talk to a loan officer. I think it's the most important first step in the process, and you'll learn a lot about, again, what can I afford? What are my payments? Where do I want to be budget wise?
Right.
And then, and that's where we get out and we start shopping, looking at homes, finding the right thing for you.
Awesome.
Yeah. And, as a real estate agent, I kind of look at myself or any good real estate agent, I kind of look at myself as a quarterback of the transaction.
Right.
Because really from start to finish, a good real estate agent is your main point of contact. But, you've got your loan officer who is the expert on the whole lending side of things. You've got the title company. You've got all these different parts of things. And, where I come in is I'm kind of coordinating all of those things. And so, and we can't do it without a great loan officer, because probably one of the biggest parts of the whole transaction. So,
Yeah, I will agree with you on that. Not just because I am the loan
yeah,
officer, but I have recently this year I've gotten more deals from other lending institutions and lenders because of mishaps, right?
mm-hmm.
And fortunately, I've been able to save every single one, right? Now we maybe we didn't hit that original closing date on that purchase agreement, but we didn't miss it by much,
Right.
But having those because a lot of those times it didn't was there wasn't enough information provided at the beginning.
Right.
There wasn't enough done by the lender after under contract. I just literally got one where like the lender ghosted them and then called and said,
Yeah.
"Hey, we're not gonna make the closing date 6 days before closing
Mm-hmm.
because they completely like didn't get anything done." Right.
Yeah.
So,
Yeah, having all the information, having the right information.
the right information.
I mean, I've run into times where, you know, just simply the wrong information was provided. And, when you get into underwriting and then all of a sudden, oh, we need updated.
What about this condo in Florida that you
Right.
have?
So that's very important, is just make sure you provide the actual
it's
correct
free and clear.
information. Yeah.
It's like there's no mortgage on it.
Right.
Yeah, but you still own it.
Yeah.
And we do see there's an HOA payment every month and there's insurance. So there's the reasons why,
Right.
There's a lot of this stuff. And, way I like train my LOs in is looking for all of those things, the red flags and these other things like that. Because guess what? I got caught in them, right?
Mm-hmm.
And granted, I've always been able to overcome them, but there's some that you just can't. You just can't, right? So, what other? Let's talk about this. So you now recently empty nester. Now you're talking about downsizing.
Yeah, my youngest is graduating college and actually in 2 weeks.
Awesome.
So I haven't had, I'm a grandfather.
Yeah. Congrats.
So yeah, it's fantastic. And I am an empty nester. And of course I miss having the kids around,
Sure.
But I'm at a interesting point in my life where I have a lot more time to, I think I enjoy my job more because
right.
I'm not just constantly on the run. I mean, we all know what it's like when you have kids that are in sports and dance and hockey and, and you're working and you're in the grind,
right.
And so I'm enjoying it. It's been really nice. And I've, frankly been able to focus more on good work.
Good.
And it's fun.
Well, that's, part of, every job is having that ability to enjoy it.
Right.
When you're in that grind and you're running from here to there, and then you have these issues that are popping up and it's just stress and that it leaks over everywhere. Right.
Yeah. So and every parent knows how awesome it is to have kids, but we also know how hard it is.
Right.
It's just a grind,
right.
Right. So yeah, I'm enjoying it.
Well, good for you.
Yeah.
Good for you. And I think a lot of people will say this sentiment too. I think, and there's a lot of things going on in the world today, right? Issues across everywhere you look. But I do think that 26, 27, the coming years are going to be a lot better, specifically in real estate. The affordability is going to be coming back. And I do think, I've been on some pretty big calls with some economists and like what the jobs look like, and this whole AI revolution. And I think there's going to be there could be some turbulence. A long term, I think realistically, the affordability is going to really come back.
Right.
And wages are really going to start increasing. And there's two sides to every coin, right? So there's the glass half full, the glass, whatever you want to call it. Um, and nobody knows for sure. Again, crystal ball, but nobody knows for sure. But
Right.
I do think what I see, and I've been building AI for 2 years now for mortgage, and what I see coming, and it's we're not taking jobs away, but we're certainly going to make it so it's a lot
Right.
cheaper for mortgage on the affordability side.
Mm-hmm.
Um, and that we can do more with less,
Yeah.
right? So,
Yeah. I mean,
uh,
that's, I mean, the world is changing a lot every day. And I mean, so far, my experience with AI has been that it's really kind of enhanced my work, and
mhm.
it's made a lot of things easier. But I'm really optimistic for 26, 27. I think the market is very strong. And like I would tell my own kids, and the way I, like when I purchased my first house is, if you ever want to own a home, get in the game.
Right,
You got to get in the game, because then you're part of that's you building your family wealth. You get to appreciate, you get to realize appreciation in your home, and
right,
put yourself in a position. It's not the only way, but it's
right.
one of the big
One of
ones,
the
I
ways,
think. And to put yourself in a position to, 5, 10 years down the line, and you want to move up and do it to a house, or,
right?
it just opens so many doors
Yeah.
in my own personal experience.
Yeah,
And
you're not wrong.
yeah.
If I could, I will say this: if I could do life all over again, right? A lot of people hindsight
Hmm.
2020. If I could do
We
life
would
all
both
over
be
again,
geniuses, I tell you
right?
that, after,
Right. But this is where I'm going at is like if I was 21 years old right now and I had a good job and I was renting, I would immediately, and I was single, right? 21, I was single. I would immediately buy a home, get out of renting,
yeah.
buy a home, get roommates,
Rent
and
out to your
then
roommates.
a couple years later, buy the second home. You can go from one home to the next home with 5% down.
Right.
You don't have to have 20% down. Do it over, and if I did it 3 times, maybe the second one's a duplex,
Hmm.
and then the third one's another primary residence. And by that time, your wealth exponentially, by the time you're 30,
Yeah.
is
Yeah, you'd
right,
be so ahead of the curve.
right,
Yeah.
right. So building wealth through real estate has always been,
Yeah.
if you look at the last 80 years, you've had like 3 dips. And
Yeah.
where did it go?
Yeah.
Right back
We
up.
lived through one of the biggest,
Right.
and and the market has recovered amazingly.
Correct.
And that one was bad.
Yes. Yes,
So,
it was. Well, Brad, I appreciate you coming on the show. It's
uh,
been a great conversation as
yeah.
always.
Thanks for
Um,
having me on. I really appreciate it. This is
yes.
fun.
We'll be sharing your information. All of you out there, please like and subscribe. If you have any questions directly for Brad, please reach out. Also, want to thank him again and look forward to the
Yeah.
next
And
couple of
and
years.
mind if I share my
Go right ahead.
contact information? You
Yes.
can reach me directly at 952-215-7519. Call or text me. My email address is bradmartinhomes, HOMES, at gmail.com. I'd love the opportunity to have a conversation with you, whether you're looking to maybe buy a month from now or 3 years from now. It's what I do every day, and I'd love to hear from you.
Awesome.
Yeah. Thanks, Brandon.
Yep. Thanks, Brad.
Yeah.